Okay, folks. Okay, before I start, there is one announcement about next week that I want to make before I forget. Okay? You know that next week, President's Day, we don't have class. So Monday, we have no class. Wednesday, we have class, but I will not be here. You're saying, how the heck is that going to work? We're going to have a Zoom session next Wednesday. So basically, next Wednesday, you're welcome to show up here if you want, but I won't be here. You can watch your computer. So find a comfortable spot and watch the session. I could give you all kinds of cockamamie reasons why, but actually, it's my grandson's birthday on Tuesday, and he turned 6. So we're going to Disneyland, which is in Anaheim, which means I can't be here the next day. So this is, I think, officially, it probably is frowned down upon, a professor not teaching a class. I really don't care. Now, but next Wednesday, so it's not this Wednesday, but a week from Wednesday, it'll be just a Zoom session, okay? So I was checking out your master list, and I'm glad to see more company names show up. But I would like that list to get complete sooner rather than later. I know I send it to you 5 times a week. I nag you on it. Incidentally, if you're not getting your emails and you joined the class late, I don't maintain an email list. It actually comes from a Google group that's the school maintained based on who's registered in the class, but there's a lag between when you register and when it shows up. So it'll happen sooner rather than later. If not, take it up with IT. I don't control it. I just send it to the alias email for that Google email group. So today's class, I want to start by kind of wrapping up the beta discussion and kind of setting up to alternatives. So if you remember, we talked about how you can use beta to estimate a cost of equity, and I laid out the requirements. One is that you have to assume that investors are diversified. Somebody tell me why is that diversified investor argument so important for a beta? Do you want to try? The beta measures only the risk that you cannot diversify or market risk. It doesn't consider all those company-specific risks. And the reason we get away with it is we assume marginal investors are diversified. And second, beta comes from stock prices, right? Returns come from prices. And that makes some people uncomfortable. Why? Because we're an intrinsic value person. What do we start this class saying? Prices can't be trusted. They can move for strange reasons. And here we are estimating betas from market prices. Concede. 2 big arguments, and I've heard them repeatedly. I go to Omaha once, infrequently. I talk to portfolio managers, true value investors. They push back. So if you're uncomfortable, you have a lot of people around you who are also uncomfortable, including Warren Buffett and Charlie Munger used to say, "Hey, I don't trust betas." So here's what I want you to think about: if you don't like betas, I want you to think about what it is you plan to do instead. One is Maybe you don't want to adjust discount rates for risk. That's one thing. So why are we even adjusting discount rates for risk? Let's pick a number, use it for every company. You'd be surprised at how many investors buy into that view. How they come up with the rate, we can talk about. Let's use 10% for every company. So maybe that's one choice. The second is that you don't like to use a measure of risk based on past prices. I don't either. But then I'm going to ask you, what do you want to use instead? So what are the choices? Instead of prices, what could we use? What do intrinsic value people claim to care about? Earnings, cash flows? What if instead of standard deviation prices, we could look at standard deviations in earnings or revenues, right? The third is you're okay using prices, but you don't like this diversified investor argument, because if you take it away, then it's all risk you should be capturing, not just market risk. Or maybe you don't like using prices and you don't like the diversified investor argument. You're saying, no, I don't like either of those. So really, the point I'm trying to make is there will be people when you go to work who say that beta thing, that's academic. I don't like betas. So go along and say, I don't like betas either, but tell me what you don't like about betas. Because then I can offer you an alternative. Of course, you might say, I don't care about the alternative. I'll use 10% for every company. But then I think I can tell what's going to happen in your valuations. All risky companies are going to look cheap to you, and all safe companies are going to look risky or look overvalued because you're using one discount rate. I was also digging a hole for betas to bury them. If you remember that Bloomberg beta page, and talked about how noisy the beta was and how, how you can change. And also, we talked about how backward looking it was. There's one more thing about the Bloomberg beta page that I mentioned. Remember I said you could go in and change the parameters. The default Bloomberg beta page uses 2 years of weekly returns against a domestic index. So you ask for a US company, it'll run the regression for 2 years, weekly returns against the S&P 500. You ask for a German company, it'll take 2 years, weekly returns against the DAX. But nice thing about a Bloomberg, which you don't have with the other services, incidentally, this is a good time to mention to you, and thank you, Jake, for finding where the Bloombergs are. There are 3 Bloombergs in 305. Okay. So get on them earlier in the semester rather than later. I'm actually going to send you an email today about how to use the Bloomberg, and in 5 or 10 minutes, get all the information you need for the class. And then you're done with the Bloomberg for the rest of the semester. Get it out of the way earlier before people start to line up. But if you pull up the beta page for your company on Bloomberg, just type in, find your company, type in beta, you'll see the page that I showed you last week. And the nice thing about the Bloomberg is you can change. Change what? You can change the index from the S&P 500 to the Morgan Stanley Capital Index, or, the NASDAQ. You can change the starting point and the ending point. Instead of 2 years, you can make it 5 years. You can even change the weekly to monthly or daily. And I think they even offer you a choice of, do you want to use trade prices or bid and ask prices? That's good, right? You get to play. But there is a dark side to this. I've told people, you give me access to a Bloomberg terminal. You tell me what beta you want for your company. Give me about 30 minutes, and I will deliver a printed page with that beta. Okay? And I'll give you an example of how much betas can change. This is Petrobras, a way back. I ran a regression. So basically, I went and looked up Petrobras. And one of the things you're going to discover with Bloomberg is when you type in Petrobras, there'll be multiple listings. You can call up the domestic listing in Brazil. And when you type in beta, it'll give you the beta against the Bovespa. So that's what the beta looks like of Petrobras against the Bovespa. But Petrobras also has what are called ADRs. You know what an ADR is? An ADR is a foreign stock that's listed in the US and traded in dollars. So you don't want to deal with Brazilian stock markets. No. So when you find the Petrobras ADR and you type in beta, it runs a regression against the S&P 500 because it treats it like a US listing. So there's Petrobras against the Bovespa, Petrobras against the S&P 500. I get very different numbers. The beta that I get is 1.66 against the Bovespa, 1.98 against the S&P 500. The R squareds are different. And of course, the R squared's higher against the Bovespa. Why again? Not just that it's a Brazilian company, but it's a much bigger part of the Bovespa. Much smaller piece of the S&P 500. So the R squareds are. So you can't pick between those based on which one has the highest R squared. This is not a statistical choice, because that might seem like the logical way to go. Which one of these two betas should I use? Want to try? What do you think? Does it matter whether I do my cash flows in reais or dollars, should it? Because I've seen people say, if I do everything in reais, I should go with the beta against the Bovespa. If I do everything in dollars, if that's the way we pick betas, we're going to be in big trouble, right? You'll value a company in 6 different numbers based on which. The answer is these are both crappy betas. If I'm forced to choose, I might go with the S&P 500 simply because it is a bigger index, and the marginal investors in Petrobras do include BlackRock and State Street and Vanguard, and where do they invest in a global portfolio? If you force me to pick, I would probably go with the S&P 500, but I'd hold my lows every second of this process, because they're both really bad betas. One, because you're regressing against an index that you're a big part of. The other, because you're creating a beta estimate that has a huge range on it. At this stage, we've kind of created a problem for ourselves, because the way in which most people get betas is by running a regression. Many of them look up the Bloomberg beta page, and we've kind of stripped the mystique of that page and said, hey, this is just a regression beta, and it's not a good way to think about betas. So I think we're ready to talk about alternatives to betas, as well as how to do this better. So let me take you back to the question that we started the class with. As I said, you're going to get people who disagree with you on betas. And I said, push back on why you disagree. Is it because you don't like the fact that we use past prices? Is it because you don't like the fact that investors are diversified? Because if you can tell me what's bothering you, I can come up with, because ultimately what's a beta? It's a measure of relative risk, right? If I could create something that looks just like the beta with something else, I can live with that. So let's take the option of you say, look, I don't like the fact that that you don't like to use price-based measures. Okay? If you don't like price-based measures, then I'm going to compute things based on accounting earnings. Why? Because it's close to intrinsic, but it comes to the catch. How often can you observe the price of a stock? Every minute of every day. How often do accounting earnings get changed? Once every quarter, right? Already you can see the problem we often have with what are called accounting betas. It looks like a regression, but it's a regression of your company's changes in earnings against changes in earnings in the S&P 500. Mathematically, it's easy to do. I can do that. But the noise you're going to get in that number is going to be immense, because you have, for 5 years, 20 observations. So you have 2 years, you have 8 observations. In a regression, that's not enough data. Second, accountants smooth out earnings. You know what that means? You have a bad year, you kind of, you spread it out over time. They do it for different reasons, but it does get in the way of you estimating risk. So if you decide to go the accounting earnings route, I can give you a way of getting something that looks like a beta for a diversified investor, but based on accounting earnings. There are some people who can who estimate the cost of equity by looking at the cost of debt, which should be observable, the rate at which you can borrow money. We're going to talk about that today. So if it costs you 5% to borrow money, your cost of equity should be higher. Everybody agree? If it costs you 10%, your cost of equity should be higher than 10%. How much higher? This is where the hand waving begins. They'll say 1.5 times as high, 2 times as high. They basically make up some multiple of cost of debt, again, because they don't want to use past prices. What I'm trying to say is, if you walk away from prices, remember, you're not walking to a better way. It's a different way. It comes with its own, own limitations. Now, if you, of course, believe in what traditional finance believes, marginal investors are diversified, and price, for whatever its faults are, reflects what the risk in the company is, then you have a choice: CAPM, arbitrage pricing, multi-factor model, all the models that you spend time learning about in finance. You're saying, what if I assume investors are not diversified? Then we redefine how we think about risk. The risk then has to be the total risk in the company. not just the risk in the. So when I estimate a cost of equity for Tesla, what do I need to bring into my cost of equity? What's the biggest risk at Tesla? Come on. It's Elon Musk, right? I mean, the risk, remember, risk is both a good and a bad. He's both a visionary. There's good stuff that comes with Elon and bad stuff that comes with Elon. I did not, when I valued Tesla, did not bring that into my cost of equity. I built a beta around the businesses they're in. And the reason I was able to do that is say, look, Tesla is one of 48 companies in my portfolio. Elon can surprise me in good ways. He can surprise me in bad ways, but those surprises are going to average out across my stocks. And that was the hand waving that led me to focus just on the risk you cannot diversify with. But there are a lot of people whose only stock in their portfolio is Tesla. I don't know how they've survived the last 15 years, right? I mean, think of the ups and downs you go through. It's like being in Bitcoin. One day you're rich, the next day you're poor. One day you're bankrupt, the next day you're a millionaire. Okay? But if you have all your money in Tesla, you can see already that the way I estimated cost of equity is not going to work for you. Your measure of cost of equity has to bring in all of that other stuff. So the alternatives to, if you don't believe investors are diversified, is to build a model for risk that includes all risk. For the moment, I'm going to leave it opaque like that. But a little later, when we talk about valuing private companies, I'm going to talk about a measure called total beta, as opposed to what? As opposed to market beta, where instead of looking just at the risk, you look at all risk. So tell me what you don't like about betas, and I'll devise a variation on relative risk. So when you look at a company and you say, this is how I think about risk. Lots of debt companies have lots of risk. I'll devise a way of measuring debt ratios and converting into a number that looks like a beta, because I want something at the end of the process that looks like a beta. It's averaged around 1. High-risk companies have a beta higher than 1, but I'm completely agnostic about whether we use prices, whether you have to believe in the diversified investors. I hate this term, but don't throw the baby out with the bathwater. No, it just sounds cruel to throw babies in the first place. But basically, people throw everything about risk because they don't like betas. You don't like betas? Fine. Come up with an alternative, build it into your process. But risk matters. That's a fundamental that you can't get away from. So here are three ways if you don't like to, if you don't like the diversified investor assumption that you can bring in risk. One is to look at total standard deviation rather than the portion that's due to the market. So if I could give you the standard deviation for every stock, which I have in my data set, you can compute ratios. If IBM standard deviation is 30% and the average standard deviation for a stock is 40%, 30 divided by 40 is 0.75. That looks just like a beta, right? Without running a regression. You can look at what are called proxy models for risk. What do you use in proxy models? You let something else become your stand-in for risk. Technology companies are risky. I'll give them higher costs of equity. Utilities are safer. I'll give them lower costs of equity. Of course, it's arbitrary, but you can base it on. You can say small companies are riskier than big companies, and you can give me the intuition. But basically what you're doing here is you're substituting an alternative for betas and say, that's the way I think about risk, and I'm going to bring it into my cost of equity. Incidentally, there are people who take the CAPM that I showed you, risk-free rate plus beta times risk premium, and adjust it for these factors. They add a small cap premium, push up the cost of equity for smaller companies. Again, they're trying to bring in this belief that they have that those things cannot be diversified away or that investors are not diversified. Now, as I talked about accounting numbers, there are people who use accounting earnings, and I do compute the standard deviation in earnings for every company. It's a little tricky because you have negative earnings and positive earnings. It becomes a little tricky to compute that standard deviation because it's percentage changes, but you can do it. I reported actually on my website, in addition to betas by sector, I report standard deviations and earnings. I do it because for those people who decide to go down this route, they now have what the scalar is, what the market standard deviation in earnings is. But again, you're taking your standard deviation earnings for your company and converting it into something that looks like a beta. So I know I sound fixated on looking like a beta because I'm ultimately pragmatic. I want a cost of equity. For a cost of equity, you tell me the standard deviation is 38%. I have no idea what to do with that. I have to convert that into something that's scaled around the average standard deviation. And that then becomes a cost of equity calculation. You don't like any of the choices I've given you? I'm even okay with you saying risky stocks, 15%, safer stocks, 12%, average stock, 10%, really safe stocks, 7%. If you go to to my website, I actually report histograms of cost of capital for all companies in the world. Okay. I break them down, 10th percentile, first quartile, median. Basically, I just take 48,000 companies, compute the cost of capital. This is what a high cost of capital looks like. This is what a low is. And one of my options in my spreadsheet is, I don't like betas. I'm just going to use a high cost of capital for my company. I'll go to the third quartile. Very simplistic, but you need to adjust for risk one way or the other. If you don't like betas, find an alternative path there. I can live with it, and I'm sure you can live with it, because ultimately the end game is you want to value this company. Okay. Now, when I go into, sometimes I talk to bankers, not as much as I used to, and thank God for that, but I used to talk, so I'd go in and, bankers often use betas every day in their jobs. And so where do betas come from? There's one banker actually tried to explain to me where babies came from. I said, no, I know where babies come from. I've got 4 of them. Where do betas come from? And they look at me like I have 2 heads. He said, what do you mean, where do betas come from? They come from Bloomberg. Because that's what your relationship with betas is. I looked it up. What do you mean, where do betas come from? And then somebody in the room who remembers a corporate finance class from way back in time or evaluation class, oh, no, they come from some kind of a regression, yeah. But the truth is, betas don't come from Bloomberg. They don't come from regression. They come from choices you make as a company. Let me explain. What do betas measure? They measure how you move relative to the market. Beta is a measure of risk that is market risk. Here are the 3 things, only 3 things that you can do as a company that alter that. First is, tell me what you do. What kind of products or services do you produce? And here's the defining rule. The more discretionary your product or service is to your customers, the higher your beta will be as a company. Let me repeat that again. The more discretionary your product or service is, the higher. You know what I mean by discretionary? What does more discretionary mean? You can delay, defer buying it. The more I can defer. So I'm going to give you a very simple example to illustrate this. Let's suppose you're looking at the retail sector. And I break retail companies down to 4 groups. Luxury retail, Prada, Tiffany's, Ferragamo's. Department stores, Nordstrom's, Macy's. Discount retailers, Walmart, you can even throw Costco in there. And then grocery stores. 4 retail groups, based on what we just said about discretionary, non-discretionary, which one of these groups should have the highest beta? Which one should have the lowest beta? What do you think? Can you live without your product? Oh my God, I cannot make it. No, trust me, you will live, right? If need be, go to Canal Street, better get a version of product that's $30 and live with it. It's an ultimate discretionary product. When times are good, they sell a lot. When times are bad, people can live without their Tiffany's and their products. Should have the highest beta. Which should have the lowest beta? It's kind of tough to live without food, right? But let's look at the grocery store business and break out companies. You got Whole Foods and you got Kroger's. What is they sell groceries, right? What's the difference though? Or which one should have the higher beta, Whole Foods or Kroger's? Why? Because when you're doing well, you're willing to pay 4 times as much for the eggplant because you're worried you might die, right? When you've lost your job, you say, who cares? Inorganic, pesticide, I don't really care. I'll go buy the cheapest eggplant I want. Sprouts and Whole Foods should have much higher betas than Pathmark or Kroger's. You see already layers of this. In economics, there's a term we use for discretionary, non-discretionary in econ classes. You remember what it is? Elasticity of demand. Every class you've ever taken in this school is in service of my class. Right? So elasticity of demand. Why do we spend so? Because it determines whether you end up with a high beta or a low beta. So that's the first stop. Tell me what you do. So I want you to think about your company. That, of course, requires that you've picked a company. So if you haven't, act like you did, make up a company now. right? Think about what does it do? And if it's in many businesses, ask yourself, is it discretion? And you can already see that this new group of technology companies that have risen, it's trickier, right? Is Uber a discretionary or a non-discretionary service? Are you willing to go back and take the subway late at night? Or is this going to be something where you decide not to eat tomorrow because you have to take an Uber home? I don't know the answer, but that is the first stop. Second stop, tell me something about your cost structure. The greater the proportion of your costs that are fixed cost, it's called operating leverage, the higher your beta will be as a company. Let me repeat that again. The more of your costs that are fixed costs, the higher your beta. Why does having a lot of fixed cost increase your beta? You want to try? What is it about fixed cost that's a problem? In good times, you're great, right? In bad times, you're decimated. Classic example is what happened in 2020 with COVID. Let's take two hospitality companies, Airbnb and Hyatt. Which one do you think is more exposed? They both were obviously hit by COVID and people not being able to travel. But which one is going to be hit more? Hyatt, because they've got the hotels to maintain, right? What did Airbnb do? They laid off 80% of their employees, say, go home. They don't have the apartments, they don't have the fixed costs. I'm not saying it's a better model, but it's a different model, a more flexible model. So fixed costs. I'll tell you a sector that is killed by its fixed costs, the airline business. Think about the cost structure for an airline. Biggest single expenses, you got to lease the aircraft, fixed cost. Then you got to fly the aircraft, fuel costs, fixed costs. I mean, no, there's a little variation depending on how the plane is filled. But can you imagine getting on a flight, there are only 6 people on, and the pilot comes out and counts the number of people, 1, 2, 3, 4, 5, 6, and yells out of the window. Only 6 people on, let's fill it up halfway, let's see how far we get. There won't be 6 people left on the flight after that, right? It's not like once you've set up the schedule, you're kind of stuck. So plane costs are fixed, fuel costs are fixed, unionized airline, you've got 7 stewardesses, only 2 people on the plane, the service is about the same anyway. That cost is fixed. And every time you fly into a gate in an air, remember the way an airline controls gates is it pays the airport for those gates. The Terminal C that you fly into out of United, 100 gates, United pays for those gates. Whether 1 plane flies out of them or 50 planes fly out of them. All your costs are fixed costs. So guess how it plays out? Have you ever noticed the airlines having a normal year? They don't. They're either going bankrupt or making billions, like watching a manic depressive in action, right? That's what happens when you have a lot of fixed costs. So second stop is what's your cost structure? Third stop is tell me how much you borrowed. You're saying, why should that matter? What does borrowing money do to the beta of your equity? Borrowing money creates a fixed cost, right? What's that fixed cost? Interest expenses. And the more you borrow, the more those interest expenses are going to be, which means your equity earnings in good times look great and equity earnings in bad times look worse. It magnifies whatever you're impacted. If you can answer those 3 questions for a business, I can at least tell you whether your beta should be high, average, or low based on the choices you made. Any questions on those drivers? But it still doesn't give you how high, right? Should it be 1.6, 1.8? So I'm going to give you a 3-step process for thinking about betas that doesn't come from Bloomberg. It doesn't come from regression. I'm going to start off by estimating the beta of the business you're in. Is it discretionary? Let's call this an unlevered beta for being in the business, an operating risk beta. Basically, are you an airline or are you a grocery store? Second stop, if I can, and we'll talk about why I said if I can, I'm going to look to see whether you have higher fixed cost or lower fixed cost. I mean, I talked about the airline business, right? Most airlines have this fixed cost problem. You know, the one airline that's always been the outlier that's had more case studies written about it than any other airline over the last 50 years. Anybody want to guess what the name of that airline is? That's as a disaster, but no, we're talking about a good example, right? The American has actually it's a fixed cost problem coming out of its, every orifice of that company. Frontier is too young. I mean, I think people will write about it, but there is another airline that's been around longer that actually set up a template that now you see other airlines around the world imitating. Yes. Southwest. Southwest has always been the outlier because it runs very differently. So let's see what it does differently. Does it lease its aircraft? Yes, like every other. But for the longest time, if you took a Southwest flight, it was always a 737. Every single Southwest aircraft. Why did they do it? Because it reduced their fixed costs in terms of what they had to do in terms of maintenance crews, equipment. So I hope Southwest is not cutting back on fuel because I sometimes fly Southwest. But they're one of two airlines around the world that consistently hedges against fuel price. You know what that means? They go out in the market and they lock in their fuel costs. The other is Singapore Air. You're saying, what does that allow them to do? If you notice, Southwest airfares tend not to swing as much as other airlines. They do swing, but it's because they know their costs pretty well before they start pricing. They're a unionized airline, but they have the most flexible workforce of any airline that I've ever flown on. It's the only airline where a stewardess has checked me on to a flight. Try that with United. You could be sitting there surrounded by stewardesses. They're all checking their job description. No, I've never checked a passenger on before. You got to wait for that person behind the podium to show up. I mean, Southwest Air, stewardesses often act as comedians. They keep it's amazing how many multiple roles they play. But here's the biggest savings. I remember the first time I flew Southwest out of the New York area, and you'll see why I said New York area. It's the cheapest airfare. I lock in the fare. I'm so happy with the low fare. The day for the flight comes in, and I check to see which airport I'm flying out of. When you think airport in New York, what do you think? What are the three airports that come to mind? JFK, LaGuardia, and Newark. None of which I like, but So I look, it doesn't say EWR, so it's not Newark. It's not JFK. It says Islip. I'll be quite honest. If you're from Islip, don't take this personally. I didn't even know where Islip was. Turns out it's some town in Long Island. I was thinking, why are you flying out of Islip? I make to Islip, I get on the plane. It tells me I'm going to LA area. I land expecting to come into LAX. I come out of the airport and this huge statue of John Wayne in the middle of the airport. I said, what the heck is this? It landed me in Orange County in John Wayne Airport. And this is something you consistently used to find on Chicago, on Southwest. You fly in, you always fly in. You fly to Chicago, you don't fly into O'Hare, you fly into Midway. Why did they do that? What did they gain by doing it? What did I say United has to do? Pay Newark for every gate that they fly into. Islip, I think, pays Southwest to fly out of Islip. So we're not on the map yet. Could you put us on the map? It's a model that European discount airlines have now built themselves around, where you fly from the Paris area. It's 200 miles from Paris, but it's a Paris area into the London area, who knows, 150 miles from London. And they save themselves a ton of money. It's keeping fixed costs low. So if you can tell me something about your cost structure, I'll try to bring it in. Southwest should have a lower or a higher beta than the typical airline, given what I said. It should have a lower beta. You're going to see the informational problem on doing this, but if I can adjust for operating leverage, I will. And financial leverage, I should be able to. I should be able to see how much debt and equity you have and see if I can come up with a beta that reflects the fact that you have more debt or less debt than the typical company. So let's take this one step at a time. Let's say you know what business you're in and you're trying to adjust for operating leverage. So what do you need to observe? You need to observe what costs in your company are fixed cost and what are variable costs. If you can do that, I know how to adjust for operating leverage. I just look at the ratio, fixed cost going in the numerator. So the higher the operating leverage you have, the higher the beta should be. But take up open up the financial statements for your company or any company. And I challenge you to start breaking costs down into fixed and variable. Yesterday, I was looking at RTX, which is Raytheon. It's a company that now owns United. And I was using it for one of my books, and I was looking at the income statement. They have sales, they have cost of sales, they have SG&A. And I go through item by item, and I kept pausing and saying, is that a fixed cost? Is that a variable cost? The answer is, I really don't know. Accountants don't break costs into fixed and variable. And remember, it's not just your company you got to do this on. You got to do this on every company. So unless you have a really egregious outlier like Southwest, most of the time, you know what I end up doing? I assume that your fixed cost structure is going to look very much like the typical company. You're a grocer, you're going to end up with a fixed cost structure very much like every other grocer, because you got to lease that big space, you got to put the inventory in. I know it's cheating, but the reason we don't adjust for operating leverage is not because we don't know how to do it. It's because the information on fixed and variable costs is really difficult to find. So with operating leverage, I'm going to do a lot of hand waving, but if you're a steel company, I'm going to give you the unlevered beta of a typical steel company. And implicitly, I'm assuming your cost structure is going to look like that of a typical steel company. I can't do that with financial leverage. Because with financial leverage, I can see how much debt and equity you have and every other company has. And I can adjust for the debt to equity ratio. The approach that I'm going to use is actually an approach that's been around 55 years. It's called the Hamada Beta. It was written up in a paper written in the early 1970s. And it's built on the assumption, and when I make this assumption, you go say, that's terrible. Built on the assumption that the beta of debt is zero. Not that debt is risk-free, but if there's risk in debt, it's not market risk. You know what that allows you to do, right? It loads up all of the beta risk in a company just on the equity. You can go through the algebra, but in the Hamada beta, here's what the beta for your stock should be. It should be an unlevered beta. The unlevered beta reflects the business you're in and your operating leverage. So that's your starting point. And as you borrow money, I'm going to estimate how much you borrowed with a debt to equity ratio. So the more you borrow, the higher that ratio will be. Right? And you're saying, what's that 1 minus t doing in there? It's true, debt is a fixed cost. It creates a problem. But what else does debt bring into the mix that might actually work in your favor? Interest is tax deductible. The government almost acts like your partner, saying, if you borrow money, we'll take some of the burden off on the fixed cost by allowing you a tax deduction. So the 1 minus t captures the tax benefits you get from debt. So the debt to equity ratio captures how much you borrowed. The levered beta is the beta that you're going to see for your equity, and it'll reflect both the business choices you made and how much you've chosen to borrow. So let me pause right there. Can you have a company in a safe business with very risky equity? And what would the company have to do to convert a safe business to risky equity? What is it done? It takes lots of time. You might have heard of LBOs, right? Many of the most successful LBOs of the late 80s were done on grocery stores. Safe business, but if you take $9 of debt for every dollar of equity, remember the debt to equity ratio can be well above 100%. Typical LBO is $9 of debt for a dollar of equity. You can take a safe business with a low unlevered beta and end up with an explosively high levered beta. So when you ask me, is the equity risky? I have to look not just at the business, but also how much money you borrow. It's called the Hamada beta. It's been around 55 years. We all know its weakest link, that the beta of debt is zero. And as I said, this doesn't mean debt is riskless. It means that what happens to your debt has nothing to do with your business. Is that a safe assumption? For a company with a AAA, AA, single A rating, you could argue that, because what happens to the debt is driven by interest rates. No. But you know what a high yield bond is? These are companies that issue BB, single B, triple C. If you ever take a look at those low rated bonds and take a look at what causes them to move over time, they start to behave like stock. Why? Because they are effectively residual cash flows, right? There's no guarantee. The contractual commitment is gone. So the argument can be made that if you get to a company with BB, single B, triple C ratings, that beta of debt is not zero. It's starting to behave like equity. And people always push back. You're using a Hamada beta. We know that the beta of debt is not zero. I say, okay, I'm willing to adjust as long as you can give me a beta for debt. It's not impossible. You can estimate a beta for debt. And if you can estimate a beta of debt, there's a variant of this Hamada equation that you almost never see used, and we'll talk about why, where you adjust the beta of equity for the fact that debt is carrying some burden. Now, intuitively, here's what's happening. In the Hamada approach, everything gets loaded on the equity investor's shoulders. As you get to higher and higher debt ratios, your beta goes through the roof, 8, 9, 10. But in the adjusted approach, because the lenders come in, especially at high debt ratios and bear some of the risk, the beta of equity gets lower. So basically, you're sharing the burden, not because the lenders want to, but because they have no choice. So the reason I'm bringing that up is if you do end up using the Hamada beta, which almost everybody does, one of the classic ways in which that skunk in the room, you know what I'm talking about? One whose job it is to just point out the things that don't work. So I went to Wharton and they taught me about beta zero. This is a terrible way to do things. Okay, I'm willing to listen. Can you estimate the beta? Give him or her the task of estimating the beta of debt. Very quickly, they'll come around to the Hamada beta side because it's a nightmare. You can't look it up on Bloomberg. You actually have to do it by hand. Okay? But the beta of debt might not be zero, but all it means the beta of equity is overestimate really high debt ratios. Yeah.
So for the debt equity, we use net debt equity?
You can do either net or gross. I'll come back and talk about it. Just stay consistent because you make that choice. You got to stick with that choice. If you have no idea what the difference between net and gross is, we'll come back and address that difference. But either one will give you roughly the same cost of capital at the end if you stay consistent. So I'm going to give you the way I estimate betas. I told you I've already buried regression betas, just like I buried historical risk premiums. With historical risk premiums, I gave you my alternative, an implied premium. With regression betas, I'm going to give you my alternative. I call it a bottom-up beta, but if you don't like the term, you think it sounds odd, call it whatever you want. Here's how I go about estimating a beta for a company. So I'm going to make you my guinea pig. You've started a company, you're in 2 businesses. Pick any 2 businesses you want to be in. How about cannabis and casinos? Hey, that's a good choice. That sounds like a fun business to be in. In fact, there might be synergies involved here because people who smoke a lot of cannabis tend to lose their inhibitions at the gambling tables. You're in cannabis and casinos. You want me to estimate your beta, right? I'll be back tomorrow. Here's what I do. I go back to my office or my apartment. I collect as many publicly traded cannabis stocks as I can find. That's not true. There are about 25. They're all Canadian. Okay? A lot of cannabis companies out there. They're publicly traded. So what can I find out for each of them? I can get a beta for each of them. I get 25 companies. I get the betas. I average the beta. For the moment, hang in there. I now have an average beta for being a cannabis company. Can I find publicly traded casino companies? Yeah. I take let's say I find 100 casino companies. I take the average beta, of course. So now I have an average regression beta for cannabis companies, an average regression beta for casino stocks. That's a regression beta. Regression betas reflect both the business they're in as well as their debt to equity choices, right? So here's what I'm going to do. I'm going to clean out the effective debt. So if you can lever betas, you can unlever them. Basically, you're taking out the effective debt. I end up with an unlevered beta for being in the cannabis business and an unlevered beta for being in the casino business. You're not off the hook yet. I come back and say, can you tell me how much value you get from each? Your reaction is, I don't know how much value I get, but I get 75% of my revenues from casinos, 25% from cannabis. You know what I'm going to do next? I'm going to take a weighted average of those 2 unlevered betas. I now have an unlevered beta for your company. What's the last question you think I'm going to ask you? How much debt do you have, right? And you could say none, in which case I'm done. That is your beta. If you say I have a lot of debt, I'm going to compute a debt to equity ratio for you and come up with the levered beta for your company. Now, why did I go down this path? Because I don't like regression betas, right? But where did I get the 25 the cannabis stock betas and the 100 casino company betas? Regressions. All I've done is replace one regression beta with an average of 25 or an average of 100 regression betas. I'm going to argue you're in way stronger ground now than you were with the single regression beta. Why is that? What's the advantage of using an average of 25 regression betas instead of using one regression beta? It's a law of large numbers. Remember, if I take 25 regression betas and I average it out, the standard error of the average is going to be 1/5 the standard error of a single regression beta. Does anybody know why I got 1/5? How did I come up with 1/5? Square root of 25. When I average out the 100 casino company betas, I'm going to get a beta that's 1/10 the standard error of a typical regression beta. It's going to be far more precise. That's a first plus. So instead of those big ranges you saw in the beta, you're now getting a much tighter range. Here's the second advantage. You entered the cannabis business only last year. Why? It was illegal until then. Now you entered the business. You're either in Colorado, California, or Oregon, or some state. Your regression beta can never reflect that, right? Because you started just 6 months ago. When I do a bottom-up beta, I pick the weights. I can say, okay, you're in casinos and cannabis. I can reflect the weights you're in. I don't need history. In fact, if you've gone down this path, say, I'm picking this company, I'm making a great company built around vice. My next stop is legalized prostitution. Remember, there are 2 publicly traded companies in Nevada. You might want to sell the company to somebody else to do it. I can bring that into the process as well. You tell me what businesses you're going to be in. I can expand. You control the process now. It's much more precise. It's much more forward-looking because I reflect your choices. And now you ask me for a beta for Birkenstock. I'm no longer stuck, right? I don't need past prices. What do I need now? What businesses is Birkenstock in? So if you go and look at my Birkenstock valuation, I didn't use a regression beta. There was none. I looked at the betas for upper end or high scale footwear companies and used that as my beta for my company. You've reclaimed the power of where do betas come from. They don't come from Bloomberg. They don't come from a regression. They come from choices that companies make. So bottom-up betas are less noisy. They're updated to reflect the mix of businesses you're in. In fact, they can be updated to reflect changes I expect in that mix. And you don't need past prices. You can get them for a private business. You can get them for a division. You can value just about anything now because all you need to know is what business that thing is in. So let's try this out. I'm going to try to estimate a beta for a Brazilian company called Vale. It's an iron ore mining company, but they're basically in 4 different businesses: metals and mining, iron ore, fertilizers, logistics. Where am I getting this information? Most companies in their 10Ks break down the company into segments. They're required, IFRS and GAAP require that if you get more than 10% of your revenues from a different business, you got to break it out. So it's not like I have to go research or get inside information. This is public information. They give me the revenues they get from each business, but my job is to get a beta for Vale as a company. And here's what I did. I went looking for publicly traded companies in each business. Okay. The advantage we have now as opposed to 30, 40, 50, or even 20 years ago is this is data that you can download. You got my email on Capital IQ that I know you threw away, that none of you, how many of you actually have tried to get on Capital IQ? Oh, good. That's actually good. Somebody, have you been able to get on? Okay. Now I want everybody to get on because it's an incredibly powerful tool. A Capital IQ subscription would cost you $150,000 if you try to do it on your own. You get it for free. Okay. It's an incredible database. You can take, the entire market, 48,000, every publicly traded company, and you can screen. So I can go in and say, I want companies in the cannabis. So you got to pick through this. I want companies just in North America because I'm at and I can come up with a list of companies. I can get the betas and I can come up with it. Because I do this all through the year, I create my own beta estimates by industry at the start of every year because that's not going to change much. So you go to my website, I break all companies down into 95 different industry groups. And for each industry group, I get a beta for each one. So the reason I do it is completely selfish because when I sit down to value Vale, I need a beta for being in the metals and mining business. I don't want to start from scratch and get every metals and mining company and do it every time because that's going to add like layers of work. So I go to my industry averages. I look up the unlevered beta, which I've done in that exactly the way I did for the cannabis and the casino stocks. There were 48 publicly traded companies in the metal and mining business, big enough sample, and I used that as my unlevered beta for metals and mining. For iron ore, there were 78 iron ore companies. You're saying, that many companies? When you have 48,000 companies, it's amazing. Whatever business you pick, there'll be enough companies in there, somewhere in the world. And I do that for every business. I get the unlevered beta. To get the unlevered beta for the company, I need weights for these businesses. So I went back to the annual report for Vale and they reported the revenues. for each of these four businesses. That again, companies break down. Right? Now, if you're in a hurry, you can use revenue weights. But the weights that you're supposed to use for betas are value weights. If somehow convert revenues to estimated value, it's better. And here's where having the capital IQ access helps. In addition to getting the betas for these 48 companies in the metal and mining, I also looked up what's called the enterprise value of each of these companies. Anybody know what the enterprise value for a company is? How is it estimated? What is the enterprise value for a company? I'll help you along. What do you start with? Market cap, right? So you start with the market cap. If I stop there, it would be just the value of equity. So to get enterprise value, what do I add to that? No, the total debt outstanding, right? So you take market cap, you add the total debt, and you usually subtract out cash from net debt. What are you trying to get? You're getting an estimate of what the market thinks the value of your company is. So I have that for all 48 companies. I have the revenues for all 48 companies. So I look at the multiple of revenues that typical metals and mining companies trade at. See this 1.97? A typical mining company trades at about roughly 2 times revenues. I'm not saying it's right, it's wrong. It's the way the market is pricing. So I take the revenues for Vale, multiply them by 1.97. I get the estimated value for each business. It's like a bare bones sum of the parts pricing that I'm doing. Each part, I'm getting the revenues, applying a multiple, coming up with estimated value. Those estimated values are what I use to compute the weights. Vale is 76% iron ore mining, about 17% metals, about 5% fertilizers, and a tiny slice of a logistics business. The only rule when you compute the weights is the weights have to add up to 100%. Please don't violate that rule, then otherwise weird things will happen. Yeah.
For example, I mean, better for like large, like same industry, but large and small.
Are they? Are they? I mean, it's an empirical question, right? Don't assume they will be different. If you believe they're different, then you can look at only large metals and mining companies. That's again the advantage in Capital IQ. In addition to screening by sector and by geography, you can also screen by market cap. So one only big company. So if you believe that you're in a business where bigger companies have higher betas than smaller companies, or smaller betas than smaller companies, just when you do the comparable companies, the peer group, just add that criteria. In most sectors, at least in my experience, there is no link between size of the company and betas. It surprises people because you assume that small companies have higher betas and more risky. But remember, betas measure risk to a diversified investor. And a lot of the risk we think of in small companies tends to be company-specific risk. But if it's true, then build in that screen and you can look at only large companies. The advantage of starting with a really big database is you can add more criteria. You can say, I want only Indian retail companies when I look at a retail company, and you're able to get enough company. But the one thing is when you're done, make sure you get, what does the law of large numbers require? Large numbers, right? So if you have sample size of 3, then you got to go back and you might have to go back and forth after you've done the screens to decide if you get enough companies. So I can get a beta for Vale that reflects the business mix it has. You know, the advantage of doing betas this way is sometimes companies want to sell off divisions. Vale actually sold off its logistics business. Let's say you are my banker and I ask you to value just the logistics business. What's the beta and cost of equity you'd use for the logistics business? You're basically going to say the logistics business is a cost of equity of 10.29%, at least in US dollar terms. And that's what you would use. So you can value divisions of companies, you can value pieces of companies. Disney decides to sell off Disney Plus. I don't think it ever will, but if it does, you'd use the beta for streaming companies, subscription-based companies to come up with it. It gives you the freedom to make that choice. Question? Somebody had a hand up there. No. Okay. So any questions about the mechanics? So break your company down to business groups, look up the unlevered beta, and you're welcome to use my unlevered beta. I would suggest at least on a small sector, try it out by hand so that you can get the mechanics going. I'll give you a couple of examples. This week's valuation of the week, maybe I'll take you through the process of using Capital IQ, and coming up with the beta. But try to get yourself at least familiar with the process, even if you're using betas from some other source, including me. Now, once in a while, this question of what do you put in your comparable group will become an issue when you start looking for comparable companies. I've talked about Embraer, Brazilian aerospace company. Let's say that you want to estimate a beta for Embraer. So you go to Capital IQ, you do aerospace companies in Brazil. You know how many companies are going to show up on your list? One, and it's called Embraer. This is not working. You say aerospace companies in Latin America. Get one company. It's called Embraer. Still not working. So I said aerospace companies globally. And here's why I think it makes sense to think globally. Who does Embraer compete with? It competes with Bombardier for smaller jets, with Boeing and Airbus for the bigger jets that it sells. It competes in a global marketplace against global companies. This fixation that people have, it's saying, I get betas only by looking at companies in my market, strikes me as kind of misguided. Because betas are measures of relative risk. I should be able to compare betas across different markets. So actually, for the unlevered betas, I use the beta for all global aerospace companies. Most of the time, you give me a chemical company, a steel company. I use the beta for steel companies globally, steel companies for I'll tell you when you might not want to, and maybe you can help me. When I do this, remember we talked about the three things that drive betas: how discretionary is your product or service? What's your fixed cost structure? How much have you borrowed? The borrowing it can adjust for. Can you see a scenario where you don't want to use the global average for your company? What type of business is it in? Yeah. Something that's not discretionary in your market, but could be discretionary elsewhere in the world. But I'll give you an example. Until about 5 or 6 years ago, I don't have to do it anymore. For telecom companies in emerging markets, I used to use just emerging market telecom company betas. And here's why. In much of the developed world, telecom service had become non-discretionary. Your smartphone, your phone, no. In the emerging markets, though, it was still very much a discretionary product. So when I decided to estimate a beta for emerging market telecom companies, I said, I'm going to look just at emerging market companies because there's a difference in discretionary and non-discretionary across the markets. It's unusual, but you can see it happen. If you have a particular business where you feel that emerging markets are different from developed markets, you might decide to go with just emerging. So on my website, I report average for global companies. I also report average for emerging market companies, European companies, US companies. And you can take your pick, but making that pick, think through what kind of business am I in and can I expand my sample? With banks, for instance, it might make sense for me when I look at a US bank to look at betas for just US banks. Why? Because regulatory regimes vary across the world and that might affect your beta. But remember, this is a data problem. It's not a theory problem. If you ask me theoretically, what should I use? There is no answer. It's what are the other companies that do well when I do well and do badly when I do badly? And you're trying to bring it into the analysis. Now, who is it that asked about gross and net debt? Gross and net debt. I'll tell you what the difference between gross debt and net debt is. You go to a balance sheet, you look at the liability side, there's total debt. That includes leases as well now. That's gross debt. What's net debt? You take that number and you subtract out the cash that this company has. So I did this for the MAG 7 stocks, in my blog post. 5 of those companies had negative net debt. What does that mean? The amount of cash they owed on the balance sheet was actually much greater than the amount of debt that they owed. Apple, for instance, is 163 billion in cash and what 93 billion in debt. So net debt kind of nets out, and you can see the logic, right? I've got debt, I've got cash. What's the logic behind netting them out? Would lead me through the mindset. You can use the cash to pay down the debt. So I have $100 million in debt and $100 million in cash. That's like having no debt at all because I can pay off the debt. So understand the logic of net debt. And in much of the world, when people talk about debt ratios, they're talking net debt ratios. So be very careful when you're having a discussion with somebody from, Europe or Asia, and they say the debt ratio for this company is 7%. They're almost always talking about net debt ratios. I prefer gross debt ratios and treating cash as an asset, and here's why. Cash is here today, it could be gone tomorrow, right? You do a big buyback, the cash is gone. So to me, it's better to have, even though having no debt is viewed as equivalent to having 100 million debt and 100 million cash. In my mind, they're very different. So I prefer to stay with gross debt. But here's why we're going to converge on the same end number. When I use gross debt ratios for Embraer, I get a debt ratio of 19%. I get a beta, levered beta 1.07. Why? Because it has a lot of debt. When I use net debt ratios for Embraer, I get a minus 3.32% net debt ratio. Cash is greater than debt. And if I use that debt ratio, my levered beta actually turns out to be lower than my unlevered beta. If I stop right there, which one looks more favorable to you? What will give you a lower cost of equity? Using the lowered beta and the lower net debt ratio. Hang in there, because this beta is going to go into cost of equity. The cost of equity is going to go into a cost of capital. To get a cost of capital, what do I need? I need to multiply the cost of equity by the proportion of equity I have and the cost of debt by the proportion of debt I have. When I use gross debt ratios, having debt lowers your cost of capital because the cost of debt is much lower than the cost of equity. So with Embraer, when I do the cost of capital, you're going to see a cost of debt much lower than the cost of equity and a debt ratio that reflects the fact. But when you do net debt ratios, you end up with a lower cost of equity. But when you go to do the weights, guess what the weights will look like in your cost of capital? Give me a sense of the numbers. What's your equity weight going to be? More than 100%. And the debt weight is going to be, hang in there. You got to, you went down this road. Don't expect me to rescue you here because people say, can I just cap the net debt ratio 0%? I'm uncomfortable using negative debt ratios. You got to live with that. So if you do net debt ratios, carry this to its logical extreme because whatever you gain by having a lower beta, you'll end up losing when you do the weights for debt and equity. But the problem that people have is they go back and forth. They start with net debt ratio, they change their mind and do growth. Then you're in trouble because you mixed and matched. So I will use gross debt ratios, but if you feel more comfortable with net debt ratios, I'm perfectly okay with that, as long as you stay with net debt ratios all the way through. So let's bring together everything we've talked about in the cost of equity. Right? What's my risk-free rate? It's whatever currency I've chosen to do the analysis in, right? Might have to clean up the government bond rate. Your risk premium, you can either use a historical risk premium, but as I said, that's getting increasingly dangerous. The world shifts under us. So I gave you the alternative of using an implied premium, where you back it out of what the market's at. And the beta is to come from the business of business. Everything has its role. Currency is in your risk-free rate. Your country risk is in your equity risk premium. And your beta measures what kind of business you're in. Don't try to mismatch or mix them up because you'll end up double counting or triple counting risk. Let's talk about the cost of debt. It's a long lead, and that took us, 70 pages to get to a cost of equity. Thank God cost of debt is not that involved. The cost of debt is the rate at which you can borrow money long-term today. Let me repeat that again. It's the rate at which you can borrow money long-term today. Two key words there, long-term and today. You know why I threw the long-term in there? If you look at the actual debt a company has, you'll have short-term debt, middle. I'm saying act as if it's all long-term debt. Why? Most of the time when you take short-term debt, not right now, most short-term debt is cheaper than long-term debt, right? A lot of companies take short-term debt because it costs 3% rather than 5%. Why am I replacing that cheaper cost with this more expensive cost? You're a going concern, right? That debt is going to come due and you better have a replacement, which means if you want to stay with short-term debt, the rolled over cost of the short-term debt, I'm assuming, is going to end up being equal to the long-term cost of debt. You want to speculate on the term structure, be my guest, but I'm not going to give you a lower cost of capital just because you want to take on short-term debt. So it actually makes your life a lot easier. You could have 50 different debt issues. You're acting as if all of that debt is long-term debt. I actually make it all 10-year debt to go with the 10-year T-bond rate. And it's today. Why? Because you might have borrowed money in 2019 and 2020 and 2021. Let's say you were a company that went out and borrowed a ton of money in 2021. What kind of interest rates are you going to see on that debt? You borrowed money when rates were much, much lower. The T-bond rate was 1.5%. You were able to borrow money at 3%. And there are analysts out there who, when asked to estimate the cost of debt, take the actual cost of borrowing. They take the interest. And if you do that, you completely lost the script because you're building into your cost of capital a cost of debt that used to be as opposed to a cost of debt today. Again, I'm making your life simpler because I'm saying, don't worry about the 50 debt issues you have on rates you have. If you borrowed that money today, what would it cost you? We frame the question. So if you think about a long-term cost of debt today for a US company, what am I going to start with as my starting point? The T-bond rate, right? And if you're doing it in euros, the German euro bond rate. So in a sense, the risk-free rate you are using for your cost of equity becomes your starting point. But now instead of estimating a beta and an equity risk premium, what is it that I need to estimate your cost of debt? So when you're a lender, you charge a spread. Why are you charging a spread? Because you're worried that you won't get paid back. The more I worry, the bigger the spread is going to be. It's called a default spread. That's it. Risk-free rate plus default spread, you're done. And there are some companies where estimating the default spread is pretty straightforward. Somebody else has done the dirty work for you. What am I talking about? What are those? Who else is out there assessing default risk and helping you along, and why? You got Moody's, you got S&P, you got Fitch. What do? They attach bond ratings to companies, right? To the degree that you trust them, and it's a big, there's a big if around there. When they say a company is BBB, they're giving you a sense of how much default risk is in the company. And even better, we know what the typical default spread for BBB rated bonds is because they're publicly traded. It's 2.5%. I'm going to add 2.5% to my T-bond rate. I'm done. That is my cost of debt, at least pre-tax. So if you have a rating, then it becomes relatively simple to estimate a cost of debt, and 80% of your companies will have ratings. The world has changed over the last 20 years. 20 years ago, only a subset of US companies had bond ratings. Now you're going to see bond ratings for Chinese companies, European companies. Most of your companies are rated. You say, how do I know? Just go into Google, search, type the name of your company, type in bond rating. And if there's a rating, you're going to find it. Fitch, S&P, Moody's, it doesn't matter who it is. Right. You're saying, what if my company does not have a rating? Your life just got more difficult because now you have to estimate the default risk in the company. You say, how the heck am I going to do that? Act like a ratings agency. They're among the most transparent organizations in the world, not because they want to be, but because what they reveal as output. What is it that ratings agencies give you? They give you the rating for every company that they rate, right? Right now, there are about 2,500 US companies with ratings. And then they give away the game. You go to the Moody's ratings website, they actually list the 8 financial ratios they say they use to come up with the rating. EBITDA to fixed charges, interest coverage ratio, debt to capital. So the 8 ratios. So I remember in the early 90s, I wanted to be like a ratings agency. Not for very long, but for a brief period so I could attach a rating. So I went down, downloaded the rating for every company, all 8 ratios. So think of an Excel spreadsheet. First column is rating. The next 8 columns are the ratios. And then I did some reverse engineering. Sounds complicated, but I just sorted the Excel spreadsheet based on ratings from AAA all the way down to D. And then within each ratings class, I looked to see which ratings were explaining why you were getting AAA, AA. And here's what I saw, and it still remains true. Half of the work of the differences in ratings was explained by one of the ratios. It's called an interest coverage ratio. You know what an interest coverage ratio is? You take the earnings before interest and taxes and divide by the interest expense. So for Embraer, that number would have been 3.56. Saying, what do I do with that? First, as a lender to a company, do you want that ratio to be high or low? You want the ratio to be as high as possible because it means the company is safer, right? You'd like it to be 8, 10, 15. That original analysis I did, which I do redo about every 2 or 3 years, I then looked at what the range of the interest coverage ratio was for each ratio. I created a lookup table where if you tell me what your interest coverage ratio is, I'll guess your rating. So if I can somehow take the 3.56 interest coverage ratio in 2004 and convert it to a rating, we'll call it a synthetic rating. So Moody's and S&P doesn't sue us. Now it's synthetic because we're concocting this rating. I should be able to get a default spread. So here's what the lookup table looked like in 2004. You're saying, why are there two columns? Because there are two sets of rules, one for small companies and another for, big companies. Small companies need to have a much higher interest coverage ratio. So see the second column, that's for small companies. The first column is for big companies. So if you're a big company with an interest coverage ratio of 5, your rating should be single A. And the default spread then would have been 0.85%. What was Embraer's interest coverage ratio? Do you remember? It was 3.56. It had a market cap greater than 10 billion. So I went looking for 3.56. There you go. That A minus rating. Even though there was no rating for Embraer, I'm assigning a rating based on the interest coverage ratio. 50% of the variation in ratings, I said, came from the interest coverage ratio. The rest of the ratios seem to be along for the ride. You see, why would ratings agencies do that? If you're a ratings agency, you want to create some noise in this process, some smoke, because otherwise, why would they pay you for a rating? They said, we're just using interest. So they'll tell you we do that. Then we do a lot of qualitative stuff. Let's face it, at the margin, you can predict the rating for a company very easily by just looking at its financials. And that's what I'm trying to do. But it's not the rating per se. What it allows me to come up with as a default spread that allows me to move on. So when you look at estimating a cost of debt, look for a rating first. No, don't go looking for trouble. If it's already rated, use the rating to come up with a default spread. But if it's not rated, it's a lot more work to do because you got to come up with some measure of synthetic ratings and a default spread. And that'll at least give you the pre-tax cost of debt. One final quirk, right? When ratings agencies rate companies, they factor in where you operate as a company. What does that mean? If you're a Brazilian company, you got to work a lot harder to get an A rating from S&P than if you're a US company. Why? Because you carry the burden of country risk on your shoulders. They say, you're a Brazilian company. Brazil is a risky country. In fact, ratings agencies used to have an explicit rule that no company in a country could exceed the rating of the country. Imagine being a Bolivian company or a Venezuelan company. You can never be above CCC rated because the country, it's incredibly unfair because you could be the safest company and the face of the earth, but because you're in the wrong place in the world, they've relaxed that, but it still shows up. So if you look at a Brazilian mining company versus a US forget mining companies, take Embraer. Embraer is now rated, compare Embraer's rating to Boeing's rating. Boeing is a basket case as a company, but it has a higher rating than Embraer does. You think that's not fair? Hey, life isn't fair. Where you are incorporated and listed as a company will affect your rating. But here's how I bring in the cost of debt. When I did the cost of debt for Embraer, since I was doing it myself, I started with the default spread for the company, but I also added a default spread for Brazil to the mix because I said I can't avoid it. You're saying why 2/3? You could add the entire default spread. You could add a half. You could use the lambda that you use. But some measure of country risk is going to show up in your cost of debt. So your cost of debt is the rate at which you can borrow money today. And all through this, I kept talking about the pre-tax cost of debt, as opposed to what? The after-tax cost of debt, right? And we talked about it. Interest is tax deductible. So if you borrow money at 8%, you're in effect borrowing money at a much lower rate because you get a tax savings. You know how you convert a pre-tax cost of debt to an after-tax cost of debt? What do you need? You need a tax rate. And this becomes one of those questions of where do I get the tax rate? Don't go looking in the annual report because they'll give you an effective tax rate, which is what the company actually paid. Last year, Apple had an effective tax rate of 16%. That's not the tax rate that you should be using to get the after-tax cost of debt. What you should be using is called the marginal tax rate. Does anybody know what a marginal tax rate is? How would I get it for Apple? What is a marginal tax rate? It's the tax rate you pay on your last dollar of income, right? It's not on your average. Why? Because interest is at the margin. So when you have $1 million in income, let's say you do, and you have $100,000 in interest expenses, it's getting awfully close to April 15th. I have to do my taxes. Help me out. $1 million in income, $100,000 in interest expenses. What do I report? $900,000 in taxable income, right? Think of where I saved on taxes. Not in the first 100,000, not in the middle 100,000, but in the last 100,000. I need a marginal tax rate. You say, where do I get that? You go to the tax code. What's the marginal tax rate in the US right now? At least until 2026, and I'll talk about what's significant about 2026. What's the marginal tax rate? Anybody know what the federal corporate tax rate is? It used to be 35%, it's now 21%. That was the 2017 Tax Reform Act, 21%. But in the US, you got federal taxes, you got state and local taxes. If you all add that all up, your tax rate could be anywhere from 21% in some states to 27 or 28% in states like California. So roughly speaking, the marginal tax rate in the US is 25%. So when I do the cost of debt for Apple, I'm going to use that marginal tax rate to do it. If you picked a company that's a US company, the 25% works. And you're saying, what's significant about 2026? I've never understood how Congress passes these tax reform acts that magically disappear 10 years down the road. You know, the entire 2017 Tax Reform Act goes away into thin air in 2026 unless it's renewed. And if that happens, the federal marginal tax rate will go to 35%, which is what it was before 2021, which means your marginal tax rate could very well become 40% 2 years from now. For the moment, don't worry about it. That's not, nobody knows what Congress will do. Congress doesn't know what Congress will do. How the heck can we estimate what it'll do? But that's the after-tax cost of debt. So I'll leave you with the final point about default spreads in general. Do they change? Yes, a lot sometimes. This is 2022, a horrifically noisy year for default spreads because during the course of the year, default spreads shot up. And if that looks familiar, that's what happened to equity risk premiums during the year as well. Fear drove everything up. So I actually update default spreads, and the most recent default spreads are right there, 2024 default spreads. So if you have a rating for your company, that's a default spread you're going to be adding on to the risk-free rate to come up with the cost of debt. I will see you on Wednesday, and we will wrap up the cost of capital calculation.
Very, very not factor in the